My question deals with tobacco stocks, which have been beaten down lately. Does Berkshire own any tobacco stocks, and are some of these stocks attractive now that prices are down on some of them, and in particular a company called UST? Thank you.
Yeah, we have owned, we won't comment on what we own now, but we have owned tobacco stocks in the past. We've never owned a lot of them, although we may have made a mistake by not owning a lot of them. But we've owned tobacco stocks in the past, and I've had people write me about whether we should do it or not. We own a newspaper in Buffalo. It carries tobacco advertising. We don't. Well, actually, Charlie's the director of a sensational warehouse chain called Costco, which used to be called Price Costco. You know, they sell cigarettes. So we are part of the distribution chain with a 100% owned subsidiary. We are part of the distribution chain with a 100% owned subsidiary. And so we have felt that we would invest in tobacco stocks. We made a decision some years ago that we didn't want to be in the manufacture of chewing tobacco. We were offered the chance to buy a company that has done sensationally well subsequently, and we sat in a hotel in Memphis and in the lobby and talked about it, and finally decided we didn't want to do it. Can I give you some?
It wasn't because we thought it wouldn't do well. We knew it was going to do well.
We knew it was going to do well, but now why would we take the ads for those companies, or why would we own a supermarket, for example, that sells them, or a 7-Eleven, or a convenience store that sells them, or something of the sort, and not want to manufacture them? I really can't give you the answer to that precisely, but I just know that the one bothers me and the other doesn't bother me, and I'm sure other people would draw the line in a different way. So the fact that we've not been significant holders of tobacco stocks has not been because they've been on a boycotted list with us. That it just means that overall we were uncomfortable enough about their prospects over time that we did not feel like making a big commitment in them. Charlie?
Yeah, I think each company, each individual has to draw its own ethical and moral lines, and personally I like the messy complexity of having to do that. It makes life interesting.
I hadn't heard that before. We'll make him in charge of this decision.
No, but I don't think we can justify our call particularly. We have to draw the line somewhere between what we're willing to do and what we're not, and we draw it by our own lights.
We owned a lot of bonds at one time of RJR Nabisco, for example, some years back. And should we own the bonds and not own the stock? Should we own should be willing to own the stock but not be willing to own the business? Those are tough calls. Probably the biggest distributor the biggest seller of cigarettes in the United States is probably Walmart. Just because they're the biggest seller of everything. They're the biggest seller of Gillette products, and they're huge. And do I find that morally reprehensible? I don't. If we owned all of Walmart, we'd be selling cigarettes at Walmart. But other people might call it differently, and I wouldn't disagree with them.
I'm a recent stockholder of Berkshire. I'm sorry to say that, but it does not diminish my admiration for past performance or my confidence in future performance. I heard recently a remark by, I think, a very successful investor whom I think worked with the Bass family in Texas for a while. And one of his comments, if I understand it correctly, said something like this. Hurricane Andrew destroyed the super cat industry. And that's about all he said, and I know we're into it. I'm interested in its importance to Berkshire and your comments on it, Mr. Buffett and Mr. Munger.
Yeah, I guess I would say I don't fully understand why he would, or even partially understand why he would say that. I mean, we are in business, in the super cat business, and I should explain, super cat business is very much like it sounds. I mean, we write insurance for other insurance companies, other reinsurance companies, to protect them, to pay them at a time when something really big comes along, a super catastrophe. And Hurricane Andrew was certainly a super catastrophe. But that's the reason people do business with us. So we pay off infrequently, but we pay off big. And we paid off about $120 million at Hurricane Andrew. But if Hurricane Andrew happened today, well, at least one of the policies in SEPs we have, we would certainly be paying off at least, $600-700 million, something like that. And if it happens 5 years from now, we'll pay off a lot more than that because we will undoubtedly be writing more business at that time. So it's just part of the game. And there will be super cats of various kinds. There will be, huge quakes. There will be more hurricanes than huge quakes. And when that time comes, we will write a big check. But that doesn't, prices may be firmer after such an event. They may not be. They didn't firm as much as you might expect after Andrew happened. Andrew was a huge surprise to people. As a digression, people in the insurance business thought that they all had these models, and some of them were prepared by reinsurance brokers and some of them by various research institutes, as how much they would lose under certain kinds of circumstances. And they couldn't have been further off with an Andrew or with the Northridge earthquake. Fortunately, we don't rely on those. I don't know what exactly we do rely on, but we don't rely on those. And the Hurricane Andrew was, that's part of business with Berkshire, and we will have another one, and we'll have another one after that. So every 3 or 5 or 7 years, or who knows what, we will lose significant money in the super cat business, and we expect that over 20 or 25 years we will make more money than we lose. We bring some real advantages to that business, as I wrote about in the report, and it makes sense for us to be in it. It only makes sense for us to be in it when the premium prices are right, but when they are appropriate, we're more than willing to step up and take on a fair amount of risk. As I wrote in the report on the California Earthquake Authority, we could tomorrow face a demand for roughly $1 billion, and we are prepared to write a check that day to take care of that, and we will write it if it happens. And there aren't very many people in the world that an insured can count on to do that. The interesting thing is that the worst exposures still for super cats are not borne by us, but they're borne implicitly by some very big direct writing companies that have lots of risk on Long Island or along the New Madrid Fault or other places. And they have got, millions of policies and maybe hundreds of thousands of exposed policies, and they don't think of themselves as being in the super cat business, or they really do, but they don't think day by day about it, and they are very exposed. Our exposures are limited to a given dollar amount. That dollar amount may be large, but at least we know what it is, and we take risks that we're willing to take risks when we think we're appropriately paid. There's a mentality to bring to the super cat business that's somewhat akin to what you bring to the investment business, so we think we're well equipped for it. Charlie?
Yeah, the $1 billion would be what, 2.5% or less of the liquid assets and securities around Berkshire, and so that's irritating, but it's not going to destroy the enterprise. Whereas if you have an unwitting super cat exposure that you don't even recognize you have, it could destroy your company. 20th Century, a very well-run direct writer of insurance, they all but went broke with the Northridge earthquake.
And they didn't think it was possible either.
And they had no idea they had a super cat exposure in what they thought was a simple little direct writing insurance operation. No, I don't think we've got the main super cat risks at all at Berkshire.
GEICO lost something like $150 million in Andrew, and their initial estimate of the loss was like $35 million, and that's after they thought they'd heard about most of it. You can really get fooled in this business. In fact, 20th Century, which lost $1 billion at Northridge, just at the end of 1996, I think added $40 million, as I remember, to the reserves for the Northridge quake, which I think was in January of '94. Now, you'd think on an earthquake you'd kind of know when it was over, but you can get fooled. And down at Andrew, I mean, the costs of construction go up dramatically in an area that's been wiped out, and then there were all kinds of things in the codes. I mean, I think they started requiring architect's drawings on everything, over $5,000 in the way of repair, or some number like that. Don't hold me to the number. And of course, the architects had a field day, and then it turned out that everybody had a homeowner's policy. In the Oakland fire, for example, they all had a $300,000 book collection in their library, and who knows after the place is burned down. It's not. You get a lot of surprises in that field, and the surprises in insurance are never symmetrical. They're all bad. Zone 4.
Yes, my name is Jinting Wang. I'm from New Mexico, and I'm a shareholder. I have two questions. First, that in your 91 letter, you wrote that investors eventually repeat their mistakes. So what do you do to keep you from making the same mistake twice? And the second question is, in your 92 letter, you wrote that you attempt to deal with the problem of future earning in two ways. First is the business you understand, and the second is the margin of safety. And you said they are equally important. But if you cannot find the happy combination of faster growth at a low PE, which one do you think is more important, faster growth or low PE? That's my two questions.
I think we were told by some higher authority which one was more important there for a second. Well, they're bound together. Obviously, if you understood a business perfectly, the future of a business, you would need very little in the way of a margin of safety. So the more volatile the business is, or possibility is, but assuming you still want to invest in it, the larger the margin of safety. I think in that first edition of Graham and Dodd, if I remember, was it J.I. Casey used and said, maybe it was worth somewhere between 30 and 110 or some number. He said, well, that sounds pretty, how much good does that do you to know that it's worth between 30 and 110? Well, it does you some good if it's selling below 30 or above 110. And you need a large margin of safety. Well, if you're driving a truck across a bridge that says it holds 10,000 pounds and you've got a 9,800 pound vehicle, if the bridge is about 6 inches above the crevice that it covers, you may feel okay, but if it's over the Grand Canyon, you may feel you want a little larger margin of safety in terms of only driving a 4,000 pound truck or something across. So it depends on the nature of the underlying risk. We don't get the margin of safety now that we got in a 1973-4 period, for example. The biggest thing to do is understand the business. If you understand the business and get into the kind of businesses where surprises, by the nature, surprises are few, and we think we're largely in that type of business. The earlier part about, I've said about learning from your mistakes, the best thing to do is learn from other guys' mistakes. I mean, it's like, Patton used to say, it's an honor to die for your country. Make sure the other guy gets the honor, So our approach is really to try and learn vicariously, but there's a lot of mistakes that I've repeated. I can tell you that. The biggest one, probably the biggest category over time, is being reluctant to pay up a little for a business I knew was really outstanding, or to continue to buy it at higher prices when I knew it was outstanding. So the costs of that have been in many, many billions. And I'll probably keep making that mistake. The mistakes are made when there are businesses you can understand and they're attractive and you don't do something about it. I don't worry at all about the mistakes that come about because when I met Bill Gates, I didn't buy Microsoft or something. That's not my game. But the mistakes are made when most of our mistakes have been mistakes of omission rather than commission. Charlie?
Yeah, I think most people get very few what I call no-brainer opportunities, where it's just so damned obvious that this is going to work. And since they are very few and they may be separated by periods of years, I think people have to learn to have the courage and the intelligence to step up in a major way when those rare opportunities come by.
Yeah, you gotta be willing to take a really big bite, and it's crazy if you don't, and it's crazy if you dabble around at the edges so you're not prepared to take a big bite when the time comes.